For years, global markets operated under a quiet assumption: Japan would stay different. While the rest of the world raised rates, Japan stayed near zero. While other central banks tightened, Japan waited. While volatility hit elsewhere, Japan remained predictable. That assumption is now being questioned, not because Japan made a dramatic announcement, but because it signaled something markets were not prepared for: a possible change in direction. And when Japan even hints at tightening monetary policy, the impact does not stop at its borders. It moves through bond markets, currencies, equities, and expectations, globally. This is not a story about a single rate hike. It's a story about what happens when the last major outlier begins to move closer to the rest of the world. What just happened, and why markets paid attention immediately. What triggered the reaction wasn't a rate hike. It wasn't an emergency meeting. It wasn't a dramatic policy reversal. It was language. The governor of the Bank of Japan signaled that the central bank may need to reassess its current stance, including the possibility of raising interest rates. For most central banks, that would barely register. For Japan, it changes everything. Japan has spent decades operating under a unique monetary regime. Ultra-low interest rates were not just a policy choice. They became part of the global financial architecture. Markets weren't just aware of Japan's position, they were built around it. So when the Bank of Japan even hints at reviewing that stance, markets don't wait for confirmation. They reprice immediately. Japanese government bond yields moved sharply higher, not because rates changed, but because expectations did. Investors began to price in a future where Japan no longer suppresses yields the way it once did. That shift matters because expectations are the foundation of modern markets. Bond markets move first because they are the most sensitive to changes in assumptions. Once Japanese yields rise, the relative attractiveness of foreign bonds changes. That forces investors, not just in Japan, but globally, to reconsider positioning. This is why the reaction spread so quickly. U.S. Treasury yields moved higher. Expectations for aggressive Federal Reserve rate cuts were scaled back, and assets that depend heavily on cheap liquidity came under pressure. The key point here is timing. Markets were positioned for a world where monetary policy would gradually ease, led by the Federal Reserve. Japan's signal disrupted that narrative. It didn't overturn it, but it weakened it. And in markets, weakening a dominant assumption is often enough to trigger broad adjustment. Why Japan's signal carries outsized weight? To understand why this mattered so much, you have to understand Japan's role, not today, but over the past several decades. Japan has been one of the largest exporters of capital in the world. Because interest rates at home were so low, Japanese banks, insurers, pension funds, and investment institutions were pushed outward. They bought foreign bonds not because they were chasing yield aggressively, but because domestic alternatives were limited. This created a structural pattern. Japanese capital flowed steadily into U.S. Treasuries, European sovereign bonds, global credit markets. These flows were not speculative. They were slow, large, and persistent. That made them incredibly important. Japan effectively acted as a background buyer. Its presence reduced volatility, compressed yields, and made global borrowing easier, especially for the United States. Over time, markets stopped asking whether Japanese demand would exist. They assumed it would. That assumption influenced everything from how the U.S. financed deficits to how investors priced risk globally. Now consider what happens when that assumption weakens. If Japanese yields rise, even modestly, the incentive structure changes. Capital that once had no choice but to leave Japan suddenly has alternatives at home. That doesn't mean Japanese investors immediately sell foreign assets en masse, but it does mean new flows may slow reinvestment decisions, change, risk, tolerance, declines. Even a gradual shift matters because Japan operates at scale. This is why a small change in Tokyo can move markets in New York and Europe within hours. It's not about panic. It's about recalibration. Japan is not just another central bank adjusting policy. It is the last major pillar of ultra-loose global monetary conditions. When that pillar starts to move, even slightly, the entire structure has to rebalance. And that rebalance is happening now, in real time, across asset classes. Why this hits the United States at a difficult moment. Japan's signal would matter at any point in the economic cycle, but it matters much more now because of where the United States currently stands. The U.S. is running large and persistent fiscal deficits. That is not a temporary feature of the economy. It has become structural. Every year, the Treasury must issue enormous volumes of new debt just to finance ongoing government operations and refinance maturing bonds. For a long time, this was manageable, not because deficits were small, but because demand for U.S. debt was abundant and predictable. Foreign buyers, particularly Japan, played a crucial role in absorbing supply without demanding sharply higher yields. That environment is changing. When Japanese yields rise, even modestly, the relative attractiveness of U.S. Treasuries shifts. Japanese institutions no longer face the same pressure to send capital abroad to achieve acceptable returns. This doesn't require a dramatic withdrawal to have an effect. Even a reduction in new purchases changes the balance at Treasury auctions. Less automatic demand means yields must rise to attract buyers, and higher yields ripple through the entire U.S. financial system. Mortgage rates respond quickly. Corporate borrowing costs increase. Equity valuations adjust downward as discount rates rise. This comes at a time when markets were hoping for relief. Many investors expected the Federal Reserve to begin cutting rates aggressively in the near future. That expectation supported risk assets and helped stabilize financial conditions. Japan's signal complicates that outlook. If global yields remain elevated because one of the largest capital exporters is no longer anchoring rates, the Fed's room to cut becomes more limited. Not because the Fed changes its goals, but because the global environment becomes less accommodating. This creates a policy dilemma. The U.S. economy shows signs of slowing, particularly in rate-sensitive sectors like manufacturing and housing. Yet higher borrowing costs persist because global demand dynamics have shifted. In short, Japan's adjustment doesn't cause U.S. economic stress, but it removes a buffer that once softened it. And buffers matter most when pressure is already building. Europe's vulnerability in a world of higher global yields. Europe faces similar pressures, but with fewer advantages and more constraints. Unlike the United States, Europe does not issue debt as a single sovereign entity. Each country borrows separately, while sharing a common monetary policy through the European Central Bank. This structure works well in stable conditions. It becomes more fragile when global yields rise. Higher global rates feed directly into European borrowing costs. Countries with stronger balance sheets can absorb this pressure more easily. Others face tighter financial conditions almost immediately. At the same time, Europe is navigating a complex political and economic landscape. Slower growth across major economies, aging populations, increasing fiscal burdens, rising defense and security spending, ongoing debates over fiscal rules and integration. In this context, Japan's recalibration has indirect but powerful effects. When a major global investor becomes more selective, markets become less forgiving. Investors demand clearer fiscal trajectories and higher compensation for risk. That puts pressure on governments already facing limited fiscal space. For households, this translates into higher mortgage costs and tighter credit. For businesses, it means more expensive investment and slower expansion. And for policymakers, it narrows the range of viable choices. Japan's shift doesn't trigger a European crisis, but it reinforces an environment where policy mistakes become more costly. Europe has less room to absorb external shocks quietly. In a world of more selective capital flows, structural weaknesses become more visible and more consequential. How this is already showing up in markets, not as a shock, but as a change in behavior. One of the biggest mistakes people make when looking for major market shifts is expecting them to arrive as a single dramatic event, a crash, a crisis headline, an emergency intervention. That's not how structural changes usually appear. They show up first in behavior, and that is exactly what is happening now. The most immediate place this shift appears is in bond markets, particularly government bonds. In both the United States and Europe, bond auctions are becoming more sensitive. Demand is still there, but it is less forgiving. Small changes in issuance plans or guidance now lead to disproportionately large moves in yields. This is a key signal. It suggests that markets are no longer assuming that large, price-insensitive buyers will step in automatically. When Japan played that role, yields could remain compressed even as supply increased. Now, pricing must compensate for uncertainty. Higher yields are not just a response to inflation or central bank policy anymore. They increasingly reflect who is willing to hold long-term debt and at what price. Currency markets are reinforcing this dynamic. As expectations around Japanese rates shift, the yen becomes more volatile. That volatility raises hedging costs for Japanese investors holding foreign assets. Higher hedging costs reduce returns. Lower returns reduce incentive to invest abroad. Reduced capital flows increase volatility further. This feedback loop tightens global financial conditions without any central bank explicitly tightening policy. It's a quiet mechanism, but a powerful one. Equity markets are feeling the effects indirectly. Higher risk-free rates increase discount rates, which disproportionately affect growth stocks and long-duration assets, especially technology. This is why tech stocks and speculative assets have reacted so sharply. Nothing fundamental changed about their business models overnight. What changed was the price of money. For years, markets operated in an environment where liquidity was abundant and borrowing costs were expected to fall whenever conditions worsened. That assumption is being questioned, and when assumptions change, valuations follow. It's important to be precise here. This is not panic selling. It is not systemic failure. It is repricing. Repricing is slower, uneven, and often uncomfortable, but it is also more durable than a single shock. Markets are adjusting to a world where liquidity is not guaranteed, capital is more selective, risk must be compensated more clearly. That adjustment is already underway. Why official narratives remain cautious? Given everything we've discussed, a reasonable question emerges. Why isn't this being talked about more openly by policymakers? The answer is not secrecy, it's incentives. Structural shifts are politically inconvenient. Acknowledging a structural shift in global capital flows creates immediate problems for governments and central banks. It forces uncomfortable conversations about long-term deficits, debt sustainability, higher borrowing costs becoming permanent. These are not easy topics, especially during election cycles or periods of political fragmentation. In both the United States and Europe, leaders are under pressure to reassure voters not to introduce new constraints. So official messaging emphasizes temporary volatility, data dependence, gradual normalization. This framing maintains confidence, but it also postpones adaptation. Central banks prioritize stability, not full transparency. Central banks are not designed to explain every structural risk in real time. Their mandate is stability. Openly stating that global liquidity may be structurally tightening could trigger overreaction, especially in markets already sensitive to uncertainty. So communication stays cautious. Language remains conditional. Changes are framed as incremental. That doesn't mean policymakers are unaware of the risks. It means they are managing expectations carefully, sometimes at the cost of clarity. Markets don't wait for permission. The problem is that markets don't wait for narratives to catch up. They respond to incentives, flows, and behavior. If demand weakens, prices adjust. If risk rises, compensation increases. If assumptions break, positioning changes. By the time official narratives shift, much of the adjustment has already occurred. This is why the most important changes often feel sudden, even when they have been building quietly for months. The signals that will define the next phase. If this were a traditional crisis, the next steps would be obvious. emergency meetings, sharp policy reversals, public intervention. But this is not that kind of moment. What comes next will unfold gradually, through signals that are easy to miss unless you know where to look. Japan's behavior, not its headlines. The most important indicator is not what the Bank of Japan says next. It's what Japanese institutions do. Watch whether Japanese investors continue to participate consistently in foreign bond markets, especially during periods of volatility. In the past, they often acted as stabilizers, absorbing supply when others stepped back. If that behavior changes, even slightly, it tells you more than any press conference. A quieter presence matters more than active selling. Markets price absence quickly. Treasury auctions and demand quality. In the United States, watch how Treasury auctions clear, not just yields, but who is buying and how sensitive demand is to price. If auctions require higher yields to attract participation, that signals a shift in the balance between supply and demand. This matters because U.S. fiscal issuance is not slowing. If demand becomes conditional, borrowing costs remain elevated regardless of central bank intentions. Yield reactions versus policy moves. Another key signal is how markets respond to central bank guidance. If yields rise or remain elevated even when policymakers signal easing, it suggests that global demand dynamics, not policy, are driving rates. That would mark a meaningful change in how financial conditions are set. Central banks influence markets. They don't fully control them. Currency volatility as a stress indicator. Watch the yen closely, not just its level, but its stability. Persistent volatility creates domestic pressure in Japan, reinforcing the incentive to prioritize internal stability over foreign investment. That feedback loop tightens global conditions quietly. If currency volatility spreads across major pairs, it's a sign that capital flows are adjusting unevenly. Political adaptation, or lack of it. Finally, watch politics, not speeches, decisions. In the United States and Europe, the real question is whether policymakers begin to adjust budgets, fiscal expectations, and long-term planning to a world of higher borrowing costs. If policy remains anchored to assumptions from the low-rate era, pressure builds. Markets adapt faster than governments. When that gap widens, adjustment becomes more abrupt. These signals don't point to an imminent collapse. They point to direction, and direction matters more than timing. A system can remain stable for a long time while becoming less resilient. Japan's shift does not break the system. It removes a cushion, and cushions only get noticed when they're gone. A quiet shift that redefines the environment. What we are seeing right now is not a crisis. There is no single breaking point, no dramatic announcement, no sudden collapse, and that is precisely why this moment matters. Japan has not shocked the global financial system, it has nudged it. By signaling a possible shift in monetary policy, Japan is doing something far more consequential than raising rates. It is challenging a long-standing assumption that global markets quietly depended on. For decades, Japan functioned as a stabilizing constant. Its low interest rates encouraged capital to flow outward. Its investors absorbed risk without demanding immediate compensation. Its predictability allowed other economies, particularly the United States and Europe, to operate with fewer constraints. That environment shaped policy decisions, market behavior, and expectations. But environments change. Japan's demographic pressures, domestic financial needs, and currency dynamics are no longer compatible with the role it once played. Adjusting that role is not a choice, it's a necessity. And when a system loses a stabilizing force, even gradually, everything else has to adjust. For the United States, this means facing a future with less automatic external demand for its debt, at a time when borrowing remains heavy and political consensus is fragile. For Europe, it means navigating tighter financial conditions with limited fiscal flexibility and internal fragmentation. For markets, It means recalibrating assumptions formed during years of abundant liquidity. This is not the end of global finance, but it may be the end of an era defined by predictability and cheap money. What replaces it will not arrive all at once. It will take shape through small adjustments, repeated over time. Markets will adapt first. Politics will follow later. And by the time the shift is widely acknowledged, much of it will already be priced in. If headlines tell you what just happened in Japan, the deeper question is what no longer holds true because of it. Because in global finance, the most important changes rarely announce themselves. They happen quietly. And right now, that quiet change is already reshaping the world the United States and Europe operate in.